Good morning, you're watching News9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy 20 minutes ahead of time here on News9. With me is Suyash Maheshwari.
Hello.
As usual. Good morning, Suyash.
Good morning, Shweta.
Markets opening in green. It's a good positive start once again.
Yes, Shweta. So the markets have opened in fact in the green and have extended on yesterday's run where we saw about a 0.5% rally in both the headliners. So markets this opening has opened with Nifty rescaling the 19,600 levels, whereas sensex has surged about 150 to 160 points this morning. And the broader markets, Shweta, have also been buoyant and they have been largely in line with both the headliners, with Nifty Mid Cap 100 and the Nifty Small Cap 100 up about 0.39% and 0.3%. Also, the volatility has significantly come down. India VIX was down by about about 6% at 10.94. So this will perhaps augur well for the bulls. Now, looking at the sectors this morning, Shweta, the IT pack continued to build on yesterday's momentum. The Nifty IT pack was up about 0.4% yesterday. It rallied about 1%. The pharma pack is up about 0.67%, but today the rally is being led by the metal pack, and all the metal stocks are trading with moderate profits, and Nifty metal pack on the whole is up about 1.2%. Now, one of the reasons why the metal pack is rallying is that crude has Brent crude especially, both benchmarks have come down significantly and have cracked up by $12 to $13 in the last 2-3 days. Brent crude has fallen below the $85 a barrel mark. So that is perhaps playing in favor of the metal pack. Apart from that, the auto index is also up about 0.5%, and Nifty Bank has also is also showing some strength this morning and currently sits above the 44,250 mark.
All right, that's the lowdown as far as markets this morning is concerned. Joining us is Rohit Srivastava, founder and market strategist at India Charts. Rohit, good to have you on the show. Thank you for taking time out. What are you making of the rally in the Indian markets? Both Sensex, Nifty ended at least 0.5% higher yesterday. It looks like they're taking on from that green shoots.
Yeah, we've seen almost a 2-week correction in the Indian indices. It would look, based on yesterday's behavior, that we could be close to the end of that. You want to see the indices hold above 19,580, 19,600 for the day today. If that happens, then we can come to some kind of a short-term conclusion that yes, we have the bottom in place, and we can start looking at a bounce or even a resumption of the uptrend that was already going on for the last several months. So we're waiting for those signals, but it does look like there's an exhaustion, at least in the short term, based on some of our, sentiment indicators, and therefore the sense is yes, we may be done here. There's also an interesting, observation over the last 3 days, because this was mainly global panic. You did see the markets gap down 2 days ago, and yesterday it actually gapped up. So sort of there was no trading between the 19,450 to 19,480 range, which technically we call as an island. It happens when you reach a price point where there's panic and then relief, and then you don't go back to those lows. It ends up becoming a trap for the bears. So let's see if that happens. We'll have to observe those levels for the next 2 days to confirm what is going on.
Before I let my colleague take over, I do have to ask, we are awaiting the monetary policy decision in just about 15 minutes, as I see on the clock from now. That could be one of the reasons why markets have opened in the green. But what are your big expectations as far as, inflation commentary is concerned?
They very much stick to what they said the last time. Their inflation outlook is pretty clear that it's not dropping, but at the same time, it could sort of get flattish over here. But we don't have that big an inflation problem, I think, in India, as we have seen in other parts of the world where it is actually sticky. A lot of the food inflation we saw in the monsoons were usually the seasonal effect of what happens during this point of time because of the rains. And so it's not something that we can, really see as structural inflation. So therefore, it may be temporary. It will go away as time progresses. What you want to actually see is whether we can go back to a monetary easing condition at some point of time. I think looking at the setup globally, because there's been a significant bond market rout in the last 1 week, it may be very difficult for us to, move into a low rate environment immediately. I think we are eventually going there. So net, I think there'll be a, policy stance is going to be neutral today, just a continuation of what they've been doing so far. The commentary might just help pacify people in terms of the risks that we are seeing around the world.
Hi Rohit, so yeah, sure. I mean, yeah, RBI monetary policy, I mean, as far as the rates go, should largely be a non-event for the markets, because most of the analysts, brokerages and the reports that we are reading expects RBI to, maintain rates at 6.5% in this monetary policy meet. But do you expect them to flag some caution, given that the yields in the US have run up significantly? I mean, last time around in August, when RBI last policy meet, the US 10-year bond yields were at about 3.95% or so. Currently, they are at 4.7%. So, to stabilize rupee, prop up that short-term yields, do you expect RBI to flag some caution here?
I think RBI on its front is anyway taking action. If you simply look at the Indian currency and bond market, this has been a pretty meaningful rout, especially in the bond market globally. But the impact on our own markets has been very, very muted. In fact, in the bond market, it's been nothing. Bond yields have just not gone above 7.2% throughout this time period. USDINR has been in a very narrow range, finding it very difficult to get past 83.50. So that shows that there's a lot of stability, or there's some level of intervention where the RBI is able to manage the current situation. We are really not seeing any risk out there. They can highlight that, yes, they're watching what is going on. But I don't see any domestic risk really showing up right now. I think the only concern from the markets has been that FIIs, which is the foreign institutional investors, have been consistent sellers in the Indian market over the last 2 months and have continued to do so in the early days of October. That's a pattern you'd really want to see change. It's not happened, and I think that's the risk that is really there right now, because the route in the global markets is pushing FIIs from really starting to buy in the cash market in India, and I think that has some impact on the currency flows.
When are you expecting FIIs to evince some interests in emerging market economies? Is there a timeline that you're looking at?
Now that the bond yields have also started to ease, so perhaps in the next month or so, given that dollar
is that your expectation? What's your expectation?
So I think the dollar is key. We've seen it almost for 13-14 weeks going up consistently, closing week after week higher. Moment we start seeing that pattern reverse, where the dollar starts to weaken again, that's the first sign to expect emerging markets to start getting flows from institutional investors. So I think the dollar plays a big role when it comes to asset allocation to EMs, EM debt. Like Indian debt is likely to get far more attractive with the inclusion in so many bond indices. So that's a big reason for interest rates in India to go down. But it does require the currency front to be strong, and for that, I think the weakness in the dollar would be one reason why institutional investors would consider both emerging market equities and debt as an investment horizon.
Now, Rohit, given that the markets have seen high volatility in the last couple of weeks, the experts that we have been talking to are largely split. Some expect Nifty to perhaps break down to 19,000 levels, even in fact correct by about 5% to 18,500, 18,600, whereas others expect Nifty to rescale new highs by the time October end comes. So what is your broader expectation? Where is Nifty? Where do you see Nifty ending the October FNO series?
Yeah, so that's taking a very near-term view of things. In the big picture, we should understand that we are in a bull market. That's the main point. And if you simply look at how earnings have been growing, last quarter itself, we have a 30% Y-on-Y earnings for the July quarter. Now we're going to be starting the October earnings season pretty soon. And if it continues in that pattern, then there's good reason why equities should actually head higher, because we've already seen a correction in the last 2 months, right? August was down. We attempted to go back to the highs in September, but that gave up again. So it's sort of become a very long consolidation over 2 months. I mean, even for the Bank Nifty, it's been a range. It's not that Bank Nifty is crashing or anything. It's simply gone from the top end of around 46,600 to a bottom end of around, 43,700 odd. And if that consolidation completes, the point should be we go back higher. Now, October seasonality is also pretty good. We do that cross check on our strike software, where the best seasonal month of the year was actually July. After that, it weakens into August and September, and then it actually starts to pick up in October. So October is likely to be better than September for sure. The extent is what we really will have to figure out.
Now, I also want to touch on Bank Nifty. Bank Nifty has corrected sharply, in the last couple of weeks. In fact, it fell below the 44,000 levels very recently for the first time since, earlier September 1 or September 2. What's your broader outlook now that, we are seeing some sort of a reversal also playing out in the HDFC in the HDFC Bank stock also?
Yeah, so the first step is going to be, getting past 44,400 very, very short term. Once we do that, we can say that, okay, this 2.5, almost 3 weeks now correction is coming to an end. Once we say that, then we'll start looking initially for a retracement, typically 61% of the entire fall, which takes us back to maybe a 45,350, and then eventually back to new highs. Those are the two things we'll keep in mind, because sometimes you do falter at the retracement. You can remain in this broad 2-month consolidation range for longer. So we can't take that call immediately whether you'll remain in this range or will you, start to break out in the next move up. For that, we'll watch that particular level, 45,350. If we go past that, then the odds of going back to new highs would increase significantly.
And what's your outlook on HDFC Bank? I mean, as I said, it is seeing some sort of a turnaround, and there is, like, at least it looks on the price chart that they are building a base at around 1500, 1520. In fact, in Wednesday's session, it was the only constituent stock that gained perhaps like about 1.5%, where every other stock in the Nifty banking pack fell. So what's your broader outlook on the HDFC Bank?
So let me just mention, we don't really give investment advice. So this is just my opinion of the situation, which is that you have seen the private banks like HDFC or Kotak show weakness relative to the PSU banks. But I think there's a strong case for rotation. This market has been all about rotation. In fact, the same can be said even between mid caps and large caps. So I think it's time for some kind of rotation to happen where the private sector banks actually show some performance on a 1-2 month basis after all the selling that we have really seen, which a lot of which may be associated with the over ownership by foreign institutional investors that have been selling, right? So that also will play an important role in getting this turnaround for these particular banks. But I think private banks have a room. They're very, very oversold, so they have room to turn around and show some performance relative to PSU banks that have been, driving most of this move so far. And in fact, on the opposite side, the PSU banks have seen something which we call as a volume climax, where the most recent rally ended up seeing significant volume trades. And whenever that happens, it's time for a consolidation. So you could get rotation into the private banks relative to PSU banks.
And do you expect that correction or consolidation to continue in PSU banks, as you said? Because PSU bank, in fact, is the only sector that is trading in the negative this morning.
Yeah, it takes a month or two for consolidations to complete. So you'll have to give it that much time once it starts. I'm not putting a 100% certainty on it's happening, and there could also be a divergence within PSU banks, within the big and smaller players, just like the mid cap, large cap, because you're seeing these smaller names like Union, Canara, and so on do very well, but you really haven't been seeing performance in SBI and BOB. So if I get rotation between large caps and mid caps, you might see better performance from an SBI compared to the others. So even that must be noted when we say something like, PSU banks need to cool off or consolidate. But that might really mean only the smaller ones compared to the bigger ones.
All right. And as far as IT Pack is concerned, we are awaiting earnings, but even JP Morgan commentary coming in this morning expects it to be a washout year and perhaps a washout quarter as far as second quarter is concerned. What are your expectations with IT companies, given that discretionary spending hasn't picked up just as yet? Number of deals signed, but a substantial sort of impact of those deals will only come out, perhaps only play up by third quarter or fourth quarter.
Yeah, I think this is a tough year for IT. We did think that possibly the worst was over for the sector a month or two back, and they've moved up a bit. But if we look at this rally, it looks quite lethargic. But having said that, I don't think that you go back to the lows for the sector in terms of stock prices. But the move higher is likely to be a little slow and then pick up momentum as the year moves along. I think that is how we'll have to look at it.
But I mean, the heavyweights are rallying. In fact, in yesterday's 1% rally, TCS, Infosys also amassed a rally of about 1 to 1.5%. So, I mean, the mid-cap space might be looking a little hot right now, but do you expect the rally to continue in the large-cap stocks?
I very much do. So I did mention that there's going to be a rotation between large cap and mid cap. If we look at the mid cap indices, their RSIs were reading 87, 88 in the month of August. We saw that one day big dip that sort of helped in bringing that down a bit. You may see a further consolidation till that number comes back to a 70 or lower kind of stage. So it's very much possible that you see greater performance in large caps, which is far overdue. I think, and that's something we should very closely be watching, because when you get a large cap rally, it's also associated with Nifty going up. So you'll see pretty much, a lot of participation from the big stocks, which has been missing. I think that is something that is likely to come.
And yeah, the higher rates or for longer narrative that is coming out from the US, how much of a overhang will that play on the IT pack?
See, the Indian IT pack has been very different from what is happening in the US. Because it's a very different sector. Also, the US rates. One thing is looking at what the Fed funds rate is, and the second thing is looking at bond yields. The risk in the short term, which has been so highlighted, has actually been bond yields, and bond yields will really follow the news around inflation, the data around inflation. So inflation data has actually been cooling off over the last 2 months, though there may be some 1 or 2 week periods of data that went up a bit recently. So eventually, if the trajectory downward continues, the bond market will be quicker to trigger a reversal than the Fed itself. So in that sense, also look at how the Indian tech stocks have done relative to the Nasdaq, at least on the last month or two, because that's when you've seen the most recent correction on rising bond yields has hit the Nasdaq, but it's actually not hit Indian IT that badly. So I think we are pretty much stable here. We've discounted some of the worst, and as things improve, we should do well.
And Rohit, what's your view on the metal pack now that we are seeing some sort of a correction playing out in crude prices? In fact, they have corrected by about $12-13 in a span of 10 days.
Yeah. So I think oil prices ran ahead of the rest of the sector, because if you compare copper prices, aluminium prices, they haven't really moved up that much. The sector as a whole, of course, depends a lot on what the trend of the dollar is, which we actually discussed earlier. So as long as the dollar is rising, usually commodity prices are under pressure. Having said that, the Indian metal stocks have actually shown resilience and held up. When you look at stocks like Hindalco or Tata Steel, they've actually been moving up over the last 2 months, despite the rise in the dollar and despite weak commodity prices. So somewhere, I think participants in the market are anticipating that these trends in the near term are not going to be permanent, and some level of accumulation has already been happening in these counters. Now, once you actually see the reversal in the dollar, you will see a pickup in the commodity prices. But specifically for oil, I would just want that it doesn't move up that fast. If commodity prices move up slowly, they're really not a big component of inflation. So they won't cause a scare. If they move up fast, then it definitely scares everybody and everything. But it's still a good sign that when you get a weak dollar and rising commodity prices, the metal sector does well, and that's something to watch out for. 13 weeks of advance in the dollar means we are closer to the end of this move. Once we get that reversal, we'll definitely see the metal sector.
To everyone, this is the monetary policy statement for the month of October, and this is how it goes. Kautilya, in his Arthashastra more than 2000 decades ago, had said, "Stability enables a state not only to share its wealth equitably, but also augment it." These words are relevant even today. In fact, they have eternal validity. Macroeconomic stability and inclusive growth are the fundamental principles underlying a country's progress. The policy mix that we have pursued during the recent years of multiple and unparalleled shocks has fostered macroeconomic and financial stability. The external sector also remains eminently manageable. The twin balance sheet stress that was encountered a decade ago has now been replaced by a twin balance sheet advantage with healthier balance sheets of both banks and corporates. India is poised to become the new growth engine of the world. The need of the hour is to remain vigilant and not give room to complacency. Lessons from the past 1.5 decades and from living through the global financial crisis and the taper tantrum tell us that risks and vulnerabilities can grow even at good times. All stakeholders in the economy, be it lenders, corporates, businesses, both small and big, and even policymakers should continue to reinforce their buffers and fundamentals in the fast-changing world that we live in. So far as the Reserve Bank is concerned, we have identified high inflation as a major risk to macroeconomic stability and sustainable growth. Accordingly, our monetary policy remains resolutely focused on aligning inflation to the 4% target on a durable basis. Excuse me. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, that is the MPC. The MPC met on 4th, 5th and 6th October 2023. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, it decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, and the bank rate remain at consequently the standing deposit facility rate remains at 6.25% and the marginal standing facility, that is MSF rate, and bank rate at 6.7%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. Now, you may say that this is a status quo policy. Yes, to the extent that the rate and the stance remained unchanged, it is a status quo policy. But there are many aspects of the statement and our policy which I am going to now spell out, which will reflect, which will reveal and give an idea about our approach not only to monetary policy but also to various aspects of monetary policy as we move forward during this amidst this global challenges and headwinds. I shall now briefly set out the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation has surged in July, driven by tomato and other vegetable prices. It corrected partly in August and is expected to see further easing in September on the back of moderation of these prices. A silver lining amidst all these is declining core inflation, that is CPI inflation excluding food and fuel. The overall inflation outlook, however, is clouded by uncertainties from the fall in Kharif sowing for certain key crops like pulses and oilseeds, lower reservoir levels, and volatile global food and energy prices. The MPC observed that the recurring incidence of large and overlapping food price shocks can impart generalization and persistence to headline inflation. Economic activity, on the other hand, has remained resilient. Taking into account the evolving inflation growth dynamics and the cumulative policy repo rate hike of 200 basis points, 250 basis points, which is still working through the economy. The MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The transmission of the 250 basis points increase in the policy repo rate to bank lending and deposit rates is still incomplete, and hence the MPC decided to remain focused on withdrawal of accommodation. The MPC remains highly alert and prepared to undertake timely policy measures as may be necessary in order to align inflation to the target and anchor inflation expectations. I would now like to provide an assessment of the growth and inflation scenario. To begin with, global growth. Let me turn to a detailed assessment of the growth and inflation dynamics, starting with the external environment. As I just mentioned, the global economy is slowing under the impact of tight financial conditions, protracted geopolitical tensions, and increasing geoeconomic fragmentation. Global trade is contracting. Headline inflation is easing but rules above the target in major economies. While major central banks are signaling a peaking of their rate hike cycle, there are indications that the tight monetary policy stance could persist for longer than anticipated earlier. Sovereign bond yields have firmed up, the US dollar has appreciated, and global equity markets have corrected. Coming to domestic growth, in contrast to global trends, domestic economic activity exhibits resilience on the back of strong demand, that is, strong domestic demand. The momentum in agricultural activity in the second quarter of this financial year, that is 23-24, has been sustained, although the monsoon has been somewhat uneven. The acreage under Kharif crops as on September 29 was 0.2% above the last year's level. The industrial sector extended recovery in the second quarter. Manufacturing sector gained ground in July and August, supported by key sectors such as pharmaceuticals, basic metals, cement, motor vehicles, and food products and beverages. The Purchasing Managers Index, that is PMI for manufacturing, remained robust in September also. Services sector activity is maintaining buoyancy as indicated by healthy expansion in high frequency indicators in August and September. PMI services, the data of which was just released yesterday, has exhibited strong expansion in September. Construction activity continues to be strong. Investment activity maintained its momentum with good support from government capex. Private sector capex is gaining ground as suggested by expansion in production and imports of capital goods and new projects sanctioned by the banks. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continued to trend up, which augurs well for investment activity. The total flow of resources to the commercial sector from banks and other sources taken together at rupees 10.6 lakh crore during the current financial year so far is higher than that of last year. Merchandise exports and non-oil, non-gold imports, however, contracted though at a moderated pace in August. Services exports expanded at a healthy pace. Now, what I have done is, I have given a lot of data points in the footnote of my statement, and those of you who are interested may refer to the statement. So whatever statement, whatever I am saying here is backed up by the data points which would justify the statements that I am making. So I would suggest that if there is interest, you may refer to the footnotes which are part of my statement. Now let me move on. On the demand side, steady expansion is seen in urban consumption while rural demand is showing signs of revival. Looking ahead, domestic demand conditions are likely to benefit from sustained buoyancy in services, consumer and business optimism, government's continued thrust on capex, healthy balance sheets of banks and corporates, and supply chain normalization. Headwinds from geopolitical tensions and geoeconomic fragmentation, volatility in global financial markets, global economic slowdown, and uneven monsoon, however, pose risks to the outlook. Taking all these factors into consideration, real GDP growth for the current financial year, that is 2023-24, is projected at 6.5%, with Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. The risks are evenly balanced. Real GDP growth for the first quarter of next financial year, that is 24-25, is projected at 6.6%. Now, I said that economic activity continues to be resilient, and this is precisely what I was hinting at this is precisely what I was referring to when I said that please have a look at the footnotes. The data points will justify that statement, why we are saying that economic activity continues to be resilient and why we are projecting the current year GDP growth to be 6.5%. I would now like to focus on inflation. The heightened inflation levels in July and August at 7.4% and 6.8% respectively were largely driven by food price pressures. Vegetables with a weight of around 6% in CPI basket contributed to about 1/3 of CPI headline inflation in July and to around 1/4 of overall inflation in the month of August. Sustained inflationary pressures in cereals, pulses and spices added to the overall food inflation. On the positive side, core inflation softened to 4.9% during July and August. It has eased by around 140 basis points, 140. It has eased by around, that is core inflation has eased by around 140 basis points from its recent peak in January 2023. Further disinflation of the core component is critical for price stability. As evident from our survey, there is further progress on anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic. Now, this is a part of the surveys that which we have done, so let me repeat this sentence for better clarity. As evident from our survey, there is further progress in anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic, and the numbers are given in the footnote. While near-term inflation is expected to soften on the back of vegetable price correction, especially in tomatoes, and the reduction in LPG prices, the future trajectory will be conditioned by a number of factors. For Kharif crops, the area sown under pulses is below the level a year ago. Kharif onion production also needs to be watched closely. Demand-supply mismatches in spices are likely to keep these prices at elevated levels. The inflation trajectory will also be shaped by the El Nino conditions and global food and energy prices. In fact, global food and energy prices, if you see, over the last several months, they have been considerably volatile and they require careful monitoring, but that imparts further uncertainty to the inflation outlook. Taking into account all these factors, CPI inflation is projected at 5.4%, that is same as what we had projected earlier, and if there are questions, we will explain it during the press conference that follows usually my statement. Now, taking into account these factors, CPI inflation is projected at 5.4% for 23-24, with second quarter, that is Q2 at 6.4%, Q3 at 5.6%, and Q4 at 5.2%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 24-25, is projected at 5.2%. Now, what do these inflation and growth conditions mean for monetary policy? Let me try and answer. Over the last 1.5 years, monetary policy actions broadly included compression of excess liquidity in the system, increase in policy repo rate by 250 basis points, and change in policy stance to withdrawal of accommodation to keep inflation expectations anchored and break the stickiness of core inflation. Complementing these measures were proactive supply side interventions by the government to improve domestic availability of key food items and reduce input costs. Consequently, headline inflation moderated to 4.6% in the first quarter of the current financial year, that is from April, May and June of the current financial year 23-24, as compared to 7.3% in the first quarter of last year. So last year in the first quarter it was 7.3%. This year in the first quarter the headline inflation moderated to 4.6%. A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September as the impact of fleeting food price shocks wane. Further, underlying inflation pressures are also moderating while the impact of past monetary policy actions is still unfolding. Even so, indications are that throughout much of the third quarter of the current financial year, food inflation pressures may not see much easing, or rather may not see sustained easing. External factors like energy prices and financial market conditions continue to be volatile. All these call for careful monitoring of the incoming data and the outlook. That is, we have to monitor not only the incoming data but also the build-up of the future, the outlook, to clearly delineate the durable components of price shocks from its transitory elements. Monetary policy has to be in absolute readiness to take appropriate and timely action to prevent any spillovers from food and fuel price shocks to underlying inflation trends and risks to anchoring of inflation expectations. These are non-negotiable necessities. I would now like to turn to liquidity and financial market conditions. As I have reiterated several times in my previous policy statements, excessive liquidity can pose risks to both price and financial stability. To ensure that liquidity conditions evolve in sync with the monetary policy stance, the Reserve Bank, as a temporary measure, had imposed an incremental cash reserve ratio, that is ICRR, of 10%, which impounded about rupees 1.1 lakh crore from the banking system. The ICRR was reviewed on September 8th and is being discontinued in a phased manner ending October 7th, that is tomorrow. Moderation in excess liquidity conditions as a result of the combined impact of ICRR and advance tax outflows in September has resulted in greater recourse to marginal standing facility, that is MSF, by the banks. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. So what's happening is that a set of banks, they are depositing in the SDF every day more than 1 lakh crores. Sometimes it exceeds 1.5 lakh crores. At the same time, there are other banks which are borrowing from the marginal standing facility of the Reserve Bank of an equivalent amount. So obviously the distribution of liquidity in the banking system is skewed. This got reflected in the firming up of weighted average call rate, that is WACR, which is the operating target of monetary policy. Despite such hardening at the short end of the term structure, the average term spread in G-Secs in the government securities market, that is 10-year minus 91-day T-bills, remained at around 40 basis points in August and September, suggesting stable financial conditions. In recent months, banks have preferred to place funds under the overnight SDF instead of offering them in the main 14-day variable rate reverse repo operations, that is VRRR operations. It is imperative that banks assess their actual liquidity requirements over the reserve maintenance cycle and bid accordingly in the auctions under the main 14-day VRR operations of the Reserve Bank. It is desirable that banks having surplus funds explore lending opportunities in the interbank call market rather than passively parking funds in the SDF at relatively less attractive rates.
All right, that's RBI Governor Shaktikanta Das after the Monetary Policy Committee meeting announcing key decisions. And the key decision, of course, is that repo rate remains unchanged at 6.5%. Karthik Malhotra here with me in the studio. Karthik, good morning.
Morning, Shweta.
This was in line with expectations. Run us through the
Absolutely.
key takeaways.
In line with expectations, the repo rate is unchanged. The key policy rate unchanged at 6.5%. Growth forecast for FY24 unchanged at 6.5%. We are looking at CPI inflation, the new projections by RBI coming in for FY24 at 5.2%, well above RBI's required threshold of 4% inflation. And even the next financial year, FY25, inflation projection is kept at 5.2%. So I think any talks about a rate cut, any expectations on a rate cut seem like a far cry right now, which means we are going to be in this elevated, rate cycle for some time to come. We don't know when RBI will finally bite the bullet of cutting rates, because inflation also, as RBI Governor Shaktikanta Das just pointed out, you will see inflation easing out, because this inflation has been high in the month of July and August on the basis of high vegetable prices, right? Food prices, the spike that we saw in tomato prices, the spike that we have seen in cereal and pulses as well, have kept overall retail inflation fairly high and elevated. Now, those prices are likely to ease in coming months. RBI Governor fairly bullish that when the September data of inflation comes out, we will see some sort of a moderation in food prices, and that should bring down the overall retail inflation. But when you talk about core inflation, which is, with strips of food inflation and with strips of energy prices, we are still looking at fairly elevated levels. So an unchanged stance also of withdrawal of accommodation, unchanged rate, unchanged growth projection. So to my mind, no big surprises coming out of what RBI Governor just said.
All right, no big surprises coming from RBI Governor's MPC meeting, the minutes of which we just heard. Sujan Hajra is an Executive Director and Chief Economist joining us at this point in time. Sujan, thanks very much for taking time out. What according to you stood out as far as RBI Governor's press conference is concerned? CPI inflation for the entire year, financial year 2024 is at 5.4%. This was expected by a lot of analysts to perhaps go up, given that September data could prove to be a dampener, but that hasn't happened.
Yeah, RBI is looking at the current flare in inflation to be transitory. Having said that, given the kind of projection which RBI is giving for the next financial year, that also shows that RBI feels that the part of the rise in inflation is actually structural, and it will continue for a pretty long period. So higher for longer, that's the in policy rate, which is the point globally that's likely to play out in India also. Now, I think the surprise in this, apart from the inflation projection, the surprise is the confidence of the governor on India's growth process. He is highlighting that 6.5% growth for the financial year he's maintaining, and he is actually giving a lot of data points, particularly in his footnotes, where he is supporting this view that the growth is very strong. I think, if anything, the confidence of the governor about India's growth process, that's the surprise factor today.
Okay, but higher for how much longer, Sujan? Because, rates have been in the higher territory for a fairly long time, and there were expectations that with hopefully inflation easing, we should look at a higher growth projection and hence perhaps a lower inflation outlook, and therefore a reduction in some time to come. But that reduction doesn't seem to be anywhere on the anvil right now.
See, if you look at 6.5%, 6.5% policy rate and 5.2% inflation projection, that means you are talking about 130 bps of real policy rate.
Yeah.
And if you have seen RBI's past statements, RBI wants the policy rate to be positive in the range of 100 to 150 bps. So you are bang on at that level. So long inflation doesn't come down significantly, and RBI couple of policies back clearly mentioned, while we talk about the comfort zone of 2% to 6%, RBI is not comfortable with that. RBI wants inflation around 4%. So long the inflation is not coming down to 4%, RBI will maintain a slightly hawkish stance. Obviously, RBI won't be doing a rate hike at this juncture, especially because of the global backdrop, not so much for the domestic economy. But at the same time, RBI won't budge from the current level. My sense is that at least for a 12-month, we are in a status quo position, maybe even for longer.
Okay, and this incremental cash reserve ratio to be discontinued from tomorrow. No need to suck out that excessive liquidity anymore from the banks, which I think banks saw that surge in liquidity after the 2000 notes got withdrawn. But therefore, this policy getting discontinued from tomorrow, good move at this stage?
See, RBI doesn't want the liquidity to be seriously into deficit. If you look at the interest rate of the banks, banks are raising their deposit rates faster than their lending rates. Consequently, the spread is already coming down. If you look at the credit to deposit ratio particularly for the private sector banks, these are pretty stretched. So given all this situation, all this thing, RBI doesn't want the interest rate to rise significantly. I'm talking about the market interest rate. Therefore, slightly, despite the stance of tightening on liquidity, RBI is following more of a neutral stance already, so far as the liquidity is concerned.
Okay, and the RBI governor also spoke about reducing vegetable prices and the LPG subsidy, which is impacting the consumer directly positively by reducing the LPG prices. So in a way, giving more money in the hands of the consumer. Do you see a correlation with this move actually being fiscally prudent in an election year versus pure economics? How do you view this?
This is one thing surprisingly most people are missing out. If you look at globally, while the monetary policy has tightened very significantly since 2022, almost all countries are maintaining a pretty loose fiscal policy stance. If you look at the fiscal deficit as a percentage of GDP in US, it's 8.6%. If you look at across countries, if you look at Europe, if you look at in India, the fiscal policy remains pretty accommodative. So while you are impacting growth by increasing the monetary policy rate, at the same time you are trying to sort of ring fence growth by maintaining accommodative fiscal policy. This is happening in India. But it's important to realize this is not happening in India alone. This is happening across the world. So that is the bigger point, and this is structurally inflationary. So that's why another thing why the inflation is not coming back to the RBI's target of 4% is because you are maintaining a loose fiscal policy. This is happening in Europe. This is happening in India. This is happening in most parts of the world, with the exception of China.
But can India afford a loose fiscal policy at this stage, Sujan? Is this a prudent decision to take? When you talk pure economics, I want to leave politics aside, but is this fiscal stance a prudent one to take right now, given what is happening in the world and what is happening here in India?
If you look at you have to judge it not so much in terms of deficit, but you have to judge it from the point of view of stock of government securities. Now, as a percentage of GDP, India, the stock of government debt is not very large. On the contrary, what you have to understand, unlike in many other countries, Government of India has huge amount of assets also. For example, if you look at just the listed public sector companies, if you look at the departmental enterprises like railways and all, so a significant part of our deficit is actually collateralized. And in that sense, to support growth, to maintain a slightly loose fiscal policy, and as a result, getting a little bit of higher inflation, I don't think it's a very imprudent macro policy. I would rather think this is a more balanced macro policy rather than trying to shrink the economy. This is both economically and politically a sound policy, according to my estimate.
Okay, and if we talk about core inflation, Sujan, core inflation is sticking. Now, core inflation strips off the volatility of energy prices and food prices, and yet it sticks. So, what are the other levers available at the monetary policy level or at the fiscal policy level to remove the stickiness of inflation? Because this inflation is sticking even at the core level, not just retail inflation.
No, I would have a slightly different view here. If you look at in the last 12 months, actually core inflation has come down very significantly. Before that, for a pretty long period, core inflation was hovering around 6% mark. So, in a sense, core inflation has started coming down significantly. But here, I want to mention that RBI does not target core inflation. The mandate of the RBI is to target the headline retail inflation. And however much we talk about core inflation, because RBI ultimately looks at inflation as a monetary phenomenon. So, if you consider inflation to be a monetary phenomena, it really doesn't matter so much whether it's coming from core or non-core, because ultimately it gets transmitted. So therefore, in that sense, while RBI might draw some solace to the fact that there has been governor specifically pointed out 150 bips drop in core inflation from the peak. But however much solace we draw from the drop in core inflation, overall the overall headline inflation remaining sticky will continue to dominate the monetary policy discourse.
Sujan, what's your estimate for core inflation in the month of September? We're still awaiting September data, and therefore we don't know what inflation numbers will be for the second quarter of this year.
The way I calculate core is slightly different from the way market calculates core. The market calculates core by stripping off food and fuel. But important to understand, in India, petrol and diesel is not part of fuel. Fuel and energy includes only electricity and it doesn't LPG kind of thing, but it doesn't include petrol and diesel, which is included in transport services. So, in my calculation, if you include that, core inflation will be still somewhere close to 4.7, 4.8% kind of level during the month of September.
Okay, and headline inflation, given that a monsoon has been uneven, there's been difficulty there as far as, vegetable prices have come down, but pulses have remained, and the inflation at pulses level has remained elevated.
Yeah, there are very few commodities for which we are dependent on the global prices. Two exceptions are edible oil and pulses. And so therefore, it's not just the domestic supply disruption, also the increase in grain prices globally. That also impacts, because outside the subcontinent, pulses are actually cattle feeds. So the demand there comes from that particular source. So net, what I'm telling is that this is not just domestic factor. This is also a bit of international factor. And so therefore, these prices can remain elevated for a prolonged period, especially because we had seen that the pulses prices had fallen significantly in the last 24 months.
All right, and before we let you go, Sujan, RBI is estimating the GDP growth rate to remain intact at 6.5%. Is that the projection at your level as well?
My own projection is 6.2%.
Okay, 6.2%, quite in line with what World Bank said, in fact. In fact, World Bank said 6.3%.
6.3. Why, Sujan, why are you looking at a lower growth than what the RBI is projecting?
Our difference mainly coming from the manufacturing sector growth and a little bit on the agricultural side. I think still the projection on the agriculture and manufacturing is slightly higher than what the high frequency data are suggesting.
All right.
All right, Sujan, thank you very much for taking time out for joining us on this very important day. So Yash, let's quickly take a look at how market is performing on the back of a status quo announced by RBI monetary policy.
The market is also status quo. It has not reacted at all.
All right.
In fact, Nifty is also hovering around that 19,600 levels that we saw at open. Although banks have seen a slight uptick, that's perhaps probably because of the rollback of ICRR. So Nifty bank has surged by about 50-60 points, and it is currently hovering above the 44,300 levels. So that is as far as the market reaction is concerned.
All right, and what about stocks that you're tracking this morning?
So among the stocks, Shweta, Bajaj Finance yesterday completed, yesterday in the board meet, said that it will raise about 10,000 crore via QIP and preferential issue. Now the Bajaj Finance will raise about 8,800 crores from the QIP and about 1,200 crores from the preferential allotment to parent company Bajaj Finserv. Now the stock currently is up about 1.33%. In the last 5 days, the stock has rallied about 2.52%, and year to date, the stock is up about 21% or so. Whereas if you see the competitors, they have largely posted moderate returns as far as the month to date returns go. And if we look at Geo Financial Services also, it has largely corrected by about 10-15% from its 52-week high. So Bajaj Finance has been a clear outperformer, and this fundraise is going to help it substantially bolster its cash reserves, as well as prepare for that upcoming battle
between Geo and
Financial
Finance.
And among other stocks in focus today, Shweta, was PB Fintech. Now SoftBank is looking to offload about 2.5% stake in the company, and back in December it had offloaded about 5% stake in PB Fintech as well. Now PB Fintech is the parent company of Policy Bazaar. The stock has run up about 28% or so in the last 6 months. So perhaps we are seeing SoftBank booking some profits there, and currently before this block deal through which SoftBank will sell the stake, their holding was about 4.3%. After the sale, their holding will come down to about 1.85%. Now, among other stocks that were in focus today was Lemon Tree Hotels. Lemon Tree Hotels has opened a 669 room hotel in Mumbai, which is India's largest by number of rooms. So the stock also has seen a fair bit of a run up, as we have been talking about, in anticipation of the World Cup and the festive season and the wedding season in the next few months or so. And the average room rate have also spiked up significantly, and in the cities where the World Cup is being played at, they have spiked up by as much as 150% in some cases. So all that is auguring well for hotel stocks, and Lemon Tree being one of them is also posting decent set of gains, and even today it was up about 2% at in the morning trade. Now other stocks that were in focus today was TCS. Now TCS has completed acquisition of Kylyra and a merger with TC Delaware Technologies, and the stock has also performed fairly well in the last 5 days or so. The stock is up about 2% or 3%, and we are seeing a rebound taking place in the IT pack, despite US sticking to that higher rate for longer narrative. But TCS and other IT stocks have seen a significant, has landed some orders in the last couple of months. Infosys, for example, has landed orders worth $5 billion or so in a span of 2 months. So they are seeing some sort of a recovery and pairing of returns vis-a-vis, IT mid-cap stocks. Apart from that, there was Tata Motors. Tata Motors, now the JLR, Jaguar Land Rover, the wholly owned subsidiary of Tata Motors, reported increased sales volume on improvement in supplies. As a result, JLR was able to deliver more vehicles to its clients, and the stock has also given good returns. In fact, it was up about 0.5% or so in the morning trade. And if we look at the year-to-date returns, it's actually one of the outperformers, in the entire Nifty auto pack. In fact, year-to-date, the stock has run up about 58% or so, whereas Nifty auto is up only about 20-21%. I'm saying only, I mean Nifty has comparatively run up about 10% or so. So Nifty Auto on the whole has been an outperformer, and in that Tata Motors has been a clear outperformer, having run up about 60% or so year to date.
All right, great returns there from Tata Motors. But before I let you go, we briefly talked about crude, and crude has come down, in fact, below 80. Brent crude is below $85 a barrel.
Yeah, Brent crude has cracked about $12 to $13 in a matter of 10 days, Shweta. So that is actually helping up a lot of these metal stocks as well as commodity players, because as we know, commodity and crude prices have an inverse relationship. Most of them are priced in dollar terms. So once that crude prices come down, it becomes easier for countries like India to buy commodities at a lower price. So commodity stocks are seeing an uptick, and metal pack as a whole is seeing an uptick. In fact, this morning it was up over 1%. And it had come under pressure, given that crude prices had jumped significantly and were almost threatening to break past that $100 a barrel mark.
But that's not happening.
Yeah, I mean,
at least not
not
in
now,
the next couple of days.
Yeah, we'll keep on tracking that, given that how volatile crude prices are. But the broader expectations, even from the experts that we have been talking to, is that crude prices are expected to ease, maybe fall down to that $80 barrel mark,
80 to 85.
See some consolidation over there.
Right, $80 to $85 barrel a mark. That, of course, is the expectation as far as crude is concerned. We'll keep bringing you all those details right here on News 9. Thank you for watching.